You're listening to the Shaughnessy Group Podcast, insights on buying, selling, and growing Canadian businesses in the lower middle market. Let's begin.
What if I told you that, selling a thriving $10 million local logistics company is actually legally more complex and potentially a lot more dangerous for the seller than unloading some billion-dollar mega corporation?
I mean, it sounds completely backwards, right?
It really does. But if you're a Canadian business owner and you're eyeing an exit strategy in the near future, we're completely dismantling the biggest myth in business sales today. So welcome to this deep dive. Thank you so much for taking the time to join us.
Yeah, thanks for being here.
Our mission today is highly specific. We're unpacking exactly what you should realistically expect if you plan to sell your Canadian business in 2026. And we are focusing squarely on what's called the lower middle market, or the LMM.
Right.
Basically, these are businesses with closing payments of $50 million or less.
And honestly, this market is where the real action happens. Like, we hear about those multi-billion-dollar corporate mega mergers on the financial news every night, but over 40% of all mergers and acquisitions volume happens in this under $50 million space.
Wow, 40%.
Yeah, it's the absolute engine of the M&A world. And today, our insights are grounded in an incredibly detailed resource, the SRS Acquiem 2025 M&A Deal Terms Study.
Okay, awesome.
No, just a quick point of clarification for you as you listen. This study looks primarily at United States transaction data, but Canadian deals share heavily in these identical dynamics.
Right, the border doesn't just magically insulate you from these market standard structures.
Exactly. These benchmarks are essential for Canadian sellers to master, though, working with experienced cross-border advisors is a must when you actually pull the trigger.
Yeah, absolutely. And, I think a lot of founders harbor this fantasy that selling a business is fundamentally like selling a house.
Oh, totally.
You put it on the market, you negotiate a decent price, hand over the keys, and cash a massive check. But looking at this research, it feels a lot more like a corporate marriage, a divorce, and a completely exhausting multi-year audit, all rolled into one highly complex legal document.
That's a great way to frame it, actually. And the very first thing we have to dismantle is that whole idea of just cashing a check.
Right.
Because the physical reality of how buyers pay you has really shifted. Cash is still the primary driver, but it comes with some very real strings attached.
Let's start right there then. If the deal is getting more complex, how do I actually get my money? Is cash still king in this market?
It is, but the crown is definitely slipping a bit. The data shows that 62% of lower middle market deals in 2024 were structured as all cash transactions.
Okay, so a solid majority.
Yes, the majority of founders are still walking away with cash, but that number is actually dropping. It went down by nearly 3% year over year. Interestingly, though, the smallest deals, the ones 25 million or less, they kind of bucked the trend with a slight increase in all cash.
Okay, but overall, buyers are keeping more of their own cash in the bank. So what are they handing over instead?
They're handing over equity. In this space, 20% of deals were a combination of cash and stock, and 8% were entirely stock deals.
Oh, wow. All stock.
Yeah. And this is largely driven by private equity, or PE, portfolio companies. They are highly active acquirers, and they often want you, the seller, to take a piece of the new combined pie.
Right. Keep you invested.
Exactly. They do this to conserve their own liquid capital and, to keep your skin in the game.
Which means your financial future is now basically tied to how well they run the company after you leave. That's the corporate marriage part I was talking about.
Spot on.
But let's ground this in a real-world scenario so we can really picture it. Let's say you own that thriving Canadian logistics company we mentioned earlier. You have 50 trucks, great routes, solid revenue. The buyer comes in, looks at your books, and says, "We love it. We'll pay your full asking price of $20 million.
Right.
But only if you hit certain specific revenue goals next year."
Yeah, you're talking about an earnout.
Exactly. I don't get my $20 million on closing day. I have to go out and earn a chunk of it after the fact. So how prevalent is this scenario?
Over a quarter of all lower middle market deals, 27% to be precise, include an earnout. And this isn't some tiny holiday bonus either.
Right. It's substantial.
It's massive. The median earnout potential represents 38% of the total closing payment.
Wow.
And if your deal is under $25 million, that earnout potential actually jumps to 45%.
Are you kidding? You could have nearly half your payout tied to future performance.
Exactly. And these performance periods can stretch out too, though the data shows none of them exceed 4 years.
Hold on. I need to look at the mechanics of this. Because if I'm the seller and I'm forced to accept an earnout, wouldn't I insist that the earnout is tied to my actual profit? Like EBITDA earnings before interest, taxes, depreciation, and amortization.
You'd think so, yes.
Because if I built a highly profitable machine, I want to be measured on profit, right?
Yeah.
Not just how much gross money cycles through the top line.
Yeah.
Why wouldn't a seller demand profit metrics?
Well, that's the logical assumption for any rational business owner. You want to be rewarded for efficiency. But the data reveals something totally counterintuitive here. 63% of earnouts use top-line revenue metrics, while only 9% use earnings or EBITDA.
Wait, only 9%?
Only 9%.
That makes no sense to me. If I'm the seller, I could double my revenue by slashing my prices and absolutely destroying my profit margin. I hit my earnout, but I've ruined the company for the buyer. Why on earth would a buyer agree to that?
It's crazy, but it comes down to a lack of trust in small business accounting. Buyers frankly assume that smaller targets lack the internal financial sophistication to cleanly track, allocate, and report EBITDA post-closing without massive disputes.
Oh, I see.
Yeah. Revenue is relatively simple to track, like did a dollar come in the door, yes or no?
Right, there's a clear paper trail for revenue.
Exactly. Profit, on the other hand, requires calculating margins, overhead allocation, shared expenses. Once your logistics company is absorbed into their larger corporate structure, who decides how much of the corporate HR bill gets charged to your specific division?
Oh, man. That gets incredibly messy.
It really does. Buyers concede to using revenue metrics because it avoids a multi-year accounting war over how profit is calculated.
So even if you get your asking price, you might only see half of it in cash up front. The rest you have to grind for over the next 4 years based on top-line sales. But if they don't trust my profit tracking, how else are they protecting themselves? Because I imagine they aren't just crossing their fingers.
Oh, they absolutely aren't. They protect themselves by holding onto your money. And this is perhaps the most sobering statistic in the entire report.
Okay, brace me.
100% of lower middle market deals in 2023 and 2024 included an escrow or holdback.
Wait, all of them?
100%. It is a completely non-negotiable standard practice.
Let's translate escrow into plain English for a second. Is this basically the buyer demanding a massive security deposit on my own business, just in case they find hidden mold in the walls after they move in?
That's a perfect analogy. The buyer takes a portion of your purchase price and locks it away in a third-party account.
Right.
If they discover that you misrepresented something, maybe a massive client contract was actually expiring, or you had some pending litigation you didn't disclose during due diligence, they don't have to chase you through the court system to get their money back.
Oh, they just pull it straight from that security deposit.
Exactly.
So how big of a security deposit are we talking about here? Sticking with my $20 million logistics company, what are they holding back?
So for deals under $25 million, an average of 13.3% of the transaction value is held back. And the median traditional escrow is 10%.
Okay, let me do the math. On a $20 million deal, you are leaving $2 to $2.5 million locked in a bank account on closing day.
Yeah, it's a painful pill to swallow.
Truly.
And it gets more complicated when you look at how they structure it. The data shows 58% are bundled escrows,
Okay.
33% are for special indemnifications, and 30% are straight holdbacks. And holdbacks are heavily weighted in the buyer's favor because the buyer actually holds that money themselves, which gives them massive leverage if a dispute arises.
Wait, let's pause on that phrase, special indemnifications. Let's make sure we have a really clear, explain it like I'm 5 definition for that term. What does indemnification mean in the context of this security deposit?
Okay, think of indemnification as a specific legal promise to cover a known risk.
A known risk. Got it.
Let's say during the due diligence process, the buyer discovers your logistics company misclassified some truck drivers as independent contractors instead of employees.
Yikes, that's a tax time bomb.
Exactly. And indemnification is you saying, if the tax agency audits us for that specific issue over the next 3 years, I promise to pay the fine. They take a piece of your escrow and earmark it specifically for that known time bomb.
Okay, that makes sense. So I'm leaving $2 million behind as a shield for the buyer. But The report highlights another term, an expense fund. Tell me I'm misreading this. Does this mean sellers have to set aside their own cash just to defend themselves against the buyer later?
I'm sorry to say you're reading it perfectly. 92% of deals under $25 million require a seller expense fund, with a median of $50,000.
They're kidding.
No, and for deals between 25 and 50 million, 95% require one, with a median of $100,000. This is a dedicated pool of money set aside specifically to pay your lawyers and accountants.
This is wild. I am essentially forced to pre-fund my own legal defense just to protect the security deposit they already forced me to leave behind.
It's entirely defensive. Buyers mandate this because, well, if an issue arises and they want to make a claim against your escrow, they don't want to deal with 5 different founders who have already bought boats and can't afford a lawyer.
Right, they want someone to answer the phones.
Exactly. They want a centralized representative for the sellers who has liquid funds ready to engage in the dispute process immediately.
So I've got this expense fund sitting there bleeding legal fees if a dispute happens to protect a security deposit the buyer already took. The obvious panic for a founder is, does this ever end? Like, is there a ticking clock on how long they can raid that fund and come after my escrow?
There is a ticking clock, and it's called a survival period. This is the contractual length of time that a buyer can make claims against the representations and warranties you made in the purchase agreement.
Okay, let me apply some logic here. A $10 or $20 million business is inherently less complex than a billion-dollar multinational conglomerate, right?
Yeah.
I mean, fewer employees, fewer borders, fewer product lines. So it shouldn't take as long to find the skeletons in the closet. I would assume smaller deals have much shorter survival periods.
You'd think so, but the data proves the exact opposite. Yeah. In lower middle market deals, the median survival period is 15 months. The average is 14.3 months. That is actually longer than the 12-month median we consistently see for much larger jumbo-sized deals.
That is baffling.
And furthermore, 94% of these smaller deals that don't have insurance maintain these strict survival provisions. You cannot just sign the paper and walk away free of liability.
But why? Why does a buyer need 15 months to figure out if my $20 million logistics company has good paperwork when a buyer of a billion-dollar company only needs 12 months?
It all comes down to the quality of the books.
Oh, okay.
A billion-dollar mega corporation has an army of internal accountants, and their books are audited annually by a firm like Deloitte or PwC. A buyer can trust that financial foundation very quickly.
Whereas my logistics company...
Right, a $10 million business might have a part-time bookkeeper managing everything on a dusty copy of QuickBooks. Buyers demand a longer survival period for smaller deals because they need a longer runway to uncover the mistakes, the forgotten liabilities, and the sloppy record-keeping that inevitably comes with a smaller operation.
That is a brutal reality check. But earlier you mentioned insurance. Isn't there an insurance product for this exact scenario? I hear M&A advisors talk about reps and warranties insurance, or RWI, all the time.
Yeah, RWI is a big topic.
So why wouldn't a seller just buy a policy, shift that risk to an insurance company, get rid of the massive escrow, and actually sleep at night? Are sellers in this market just penny pinching?
It's crucial to understand this has nothing to do with penny pinching. The SRS Acquiom data shows that only 10% of deals under $25 million actually use RWI. And for deals up to $50 million, it's still only 34%.
But why is it so rare? If I'm leaving $2 million in escrow, I'd gladly pay a hefty premium to an insurance company to get my cash at closing.
The problem is that the insurance market isn't designed for you. First, the premiums and fixed underwriting fees for RWI are completely disproportionate for smaller deals.
Oh, so?
Well, the insurers have to do extensive legal and financial due diligence to issue the policy, and paying those specialized lawyers costs the same whether the deal is $20 million or $200 million. As a percentage of a small deal, the fixed cost of the insurance becomes insanely expensive.
Ah, so the fixed costs price the little guys right out of the market.
Yes. But there's a second, far more critical reason. As we just discussed, small businesses often have messier books.
Right, the dusty QuickBooks.
Exactly. So during due diligence, a buyer might flag 20 minor operational issues. Maybe employee contracts aren't perfectly standardized. Some software licenses are expired. A local permit is out of date. Insurance companies automatically exclude any known issues from their coverage.
Oh, wow. So if they find it, it's not covered.
Right. So, if your due diligence report is filled with a dozen minor structural issues, the insurance policy becomes so riddled with exclusions that it's virtually useless. The business is practically uninsurable from an RWI perspective.
This paints a very intense picture for the Canadian owner.
Yeah.
You are out there without an insurance safety net. You're negotiating these massive holdbacks and 15-month survival periods face-to-face with the buyer. Without a safety net, we really need to know who these sharks are that we're negotiating with. Who is actually buying these companies?
Understanding the buyer mix absolutely dictates how aggressive the negotiations will be. The 2024 data for these under $50 million deals shows you are mostly dealing with professional acquirers.
Okay.
55% were strategic buyers. These are larger corporate competitors in your industry looking to absorb your operations.
Right.
Then you have private equity. 26% were PE-backed portfolio companies doing add-on acquisitions, and 25% were direct private equity firms.
So it's heavily weighted toward larger corporations and private equity firms. Are many of them coming from outside North America?
Very few, actually. 11% were U.S. public companies, and only 9% were non-U.S. based. So you are primarily dealing with domestic or U.S. professional buyers who do this for a living.
Okay, let me set up one final scenario because this is where I've heard deals can literally fall apart at the finish line.
Well, this happens a lot.
Let's fast forward. Closing day finally arrives. You survived the earn-out negotiations. You agreed to the $2 million escrow. You funded your own legal defense expense fund. You agreed on a final price of $20 million for the logistics company.
Sounds like a victory.
Right. But today, on the literal day of closing, your warehouse inventory is slightly lower than it was last month because of a holiday rush, and your bank account is a bit drained because you just ran payroll and paid your quarterly taxes. Does the buyer actually care about a slight dip in the bank account on a $20 million deal?
They care down to the last cent. Seriously. What you're describing is a working capital purchase price adjustment, or PPA. And the data shows that 90% of all lower middle market deals include this adjustment mechanism. Even for the absolute smallest deals under $25 million, it's at 84%.
Wait, so on closing day, they're literally counting the pennies in the cash register and the spare tires in the warehouse before they hand over the check.
Precisely. The logic is simple. The buyer agreed to pay $20 million for a business that operates at a certain baseline. If you deliver a business on closing day that has depleted inventory, or your outstanding invoices are way higher than expected, they are going to adjust the purchase price downward right then and there to make up for the working capital shortfall.
Ouch.
Yeah, and there is actually a separate dedicated escrow just for this specific adjustment. The median PPA escrow size is 1.25% of the entire transaction value.
You know, here is the craziest part of the working capital data to me. The report notes that only 24% of these deals uses specified calculation methodology for this adjustment. Think about what that means. A small $10 million deal has the exact same messy, complicated, highly contested legal paperwork as a $500 million deal. It's like being forced to pack a massive steamer trunk for a simple weekend getaway. It's totally disproportionate.
The steamer trunk analogy is spot on. I mean, a prevailing myth in business is that a smaller price tag naturally equals a simpler transaction.
Right.
But the SRS Acquium report explicitly concludes the exact opposite. Complexity does not scale down. A $10 million business still has payroll taxes, it still has software IP, it still has environmental risks and employee liabilities. The legal mechanisms required to transfer that ownership safely don't magically shrink just because your revenue is lower.
That is profound. Let's pull all of this together because we have covered a massive amount of ground today. If you're a Canadian business owner looking at selling in 2026, the core message you need to internalize is this. Smaller deals carry more, not fewer complexities for sellers.
You must enter this process with your eyes wide open. You need to prepare mentally and financially for the reality of escrows. You must expect survival periods lasting 15 months or more where the buyer can still come knocking on your door.
Yeah.
And you really need to be prepared for the very high likelihood that a significant portion of your payoff will be tied up in an earnout based entirely on your future revenue.
Which really highlights the ultimate takeaway here.
Yeah.
Do not try to navigate this alone, and do not rely on local advisors who only handle small-scale Main Street transactions. You need a team of highly experienced M&A advisors who intimately understand both the Canadian markets and this aggressive cross-border transaction data.
The stakes are simply too high to learn these lessons on the fly during your own negotiation. You need professionals who fight these battles every day.
As we wrap up, I want to leave you with a final provocative thought to mull over. We mentioned earlier that only 9% of buyers in this space are non-U.S. based. That means there is a massive mix of U.S. strategic buyers and American private equity firms aggressively eyeing the Canadian market.
Very true.
So ask yourself this. Are you prepared for a potential cross-border culture clash in how your business is run post-sale? Because getting through the financial transaction is only half the battle. Preparing for the cultural shift when a U.S. buyer takes the wheel of your Canadian company might be the real challenge.
Absolutely. The cultural integration can absolutely be just as demanding, if not more so, than the legal integration.
A huge thank you to the Shaughnessy Group for providing these incredible data-driven insights today. If you want to dive deeper into this research and find more resources to prepare your business for a potential sale, you need to visit their website. You can find them at www.shaughnessy.group.
Tons of great info there.
Again, that is shaughnessy.group. Thank you so much for taking the time to join us on this deep dive. Take care of yourselves and good luck out there.
This podcast is for informational purposes only and is not professional advice. Consult qualified advisors for your specific situation.